So the acquirer is the company that's taking control, and it's got to be another business. So it's important that it has to be an entire business, right? So must involve taking control of a business. So a business is defined specifically. It must have its own, there must be inputs involved. There must be a process that converts the inputs into output. And the business will typically have its own assets, liabilities, revenues, expenses, etc. Right? So it must be capable of being operated on its own. There must be some sort of process that converts inputs or resources into outputs. Okay, so that is necessary, a necessary part of the definition of business. Now, a business may also be one. So typically, a business will provide goods and services, right? So typically, business will provide goods and services to customers. But sometimes the business could be one that is that of a holding company. So it may just be earning investment income, right? So there could be the process of providing goods and services to customers, or the business might be involved in earning investment income. Investment income is basically either through the interest income or dividends. If you think about Hugo mentioned Warren Buffett. Warren Buffett is the big shareholder, founder of Berkshire Hathaway. So Berkshire Hathaway invests in companies around the world. They've got holdings in companies, and they essentially they allow the companies to operate, and they earn investment income from such holdings. Okay. A similar example in Canada would be Power Financial, Prem Vatsa's group, right? So they kind of do the same thing. So it must be a business that is involved. So it should not be just the purchase of some assets. Okay. Now, a business combination can happen. Business combinations can occur in three ways, in one of three ways. The first one is through the purchase of net assets. Now, purchase of net assets involves the acquirer purchases all of the assets and liabilities, right, of the other company. All of the assets and liabilities of the other company. Okay. So to give you an example of that, we're going to talk about exercise or example 6.1. So you can see that on your screen. Those that have clicked on the link, you can also follow along. You'll be able to do work on this file and take your own notes. So if you would like to do that, please make sure you click on the link. So the information is provided here. Moose and Beaver, two companies, Moose and Beaver, had the following balance sheet, statement of financial position on December 31st, 2004, and associated fair values before the acquisition. So there was some acquisition that occurred. You're given information on Moose and Beaver. Additional information tells us that before the acquisition, Beaver had 120,000 common shares outstanding. Moose had 200,000 shares outstanding. The market price of the two companies' shares were $2 and $5 respectively. Moose has an unrecorded patent with a fair value of 50,000 and remaining useful life of 5 years. So in the books of Moose, we see there's no patent here, it's unrecorded. Beaver has ongoing litigation. The legal team expects that the lawsuit could be settled for $300,000. Now, ideally, I should say, so I'm just going to make a note here. Assume the litigation liability has not been recorded by Beaver, an unrecorded liability as well. Okay, so I should have said unrecorded litigation liability. So there's an unrecorded liability for Beaver, which is expected to be settled for $300,000. And so what happened after close of business on December 31st, 2004, Moose acquired, so Moose Company acquired the net assets of Beaver by paying $100,000 in cash and issuing 28,000 common shares. This is a part cash, part stock deal where Moose bought all of the assets and liabilities of Beaver and paid $100,000 in cash and issued 28,000 of its own common shares. Moose also incurred $20,000 in legal fees to complete the transaction. And for the 28,000 common shares they issued, they incurred $12,000 in stock issuance costs. Both of these were paid for in cash. Hugo's question is, so Hugo, if Moose already had 200,000 shares outstanding and they issued 28,000 common shares, it's an additional 28,000. The 200,000 that are outstanding, if there is a market price, then it means those shares are owned by outside shareholders. All right, so our requirement is to prepare the summary journal entry that Moose will prepare to record the transaction, this acquisition, and also prepare the statement of financial position for Moose and Beaver immediately after the acquisition. So what I did was I reproduced the balance sheet information that was provided in the question here. It'll be easier for us to link back to the numbers. So what we're going to do is first record the journal entries in the books of Moose. So in the books of Moose, Moose Inc. is basically acquiring all of the assets of Beaver. Now, in the lesson notes, I explain, and as well as in the lecture video, I explained that if there is any pre-existing goodwill, of the acquiree, the company that is acquired, is ignored by the acquirer. Okay, so the Moose is not going to take over the existing goodwill of Beaver. Any other identifiable assets or liabilities are recognized, and the acquirer will record the assets and liabilities of the acquiree at fair value, right? The Moose is going to recognize. To recognize means to record on its books. Moose is going to debit cash and the value of cash that Beaver Inc. has is 325,000. Notice I'm taking the fair value. Moose is also going to recognize the accounts receivable, and the fair value of the accounts receivable of Beaver is $180,000. I know the book value was 170, but the fair value is 180. Moose will also recognize inventory, land, and property, plant, and equipment. And I know that there will be details for the property, plant, and equipment. This is a summary entry, so hopefully you will not mind it terribly that I'm just using the expression PP&E. All of these are taken at fair value. Moose is going to ignore the existing goodwill for Beaver, okay? Moose is not going to recognize goodwill that belonged on the books of Beaver. However, Moose is now going to also record the liabilities, so credit liabilities that they're taking over. Now, the liabilities for Beaver have a fair value of 810,000. So Moose is going to record that. Now, there is an unrecognized litigation liability with a fair value of 300,000. So remember, because we were able to identify the fact that there is a litigation liability, there's an ongoing litigation, and it has a fair value of $300,000 that Beaver has not yet recorded on its books. When Moose takes over all the assets and liabilities, Moose will also be taking over responsibility for this unrecorded litigation liability. So you're going to record litigation liability. Now, we could have added the $300,000 to this amount as well. So 810,000 plus 300,000, or you can show the litigation liability as a separate amount. It's both are acceptable. So 300,000 for the litigation liability. So this basically is the list of all the assets and the liabilities belonging to Beaver that have now been taken over by Moose. Okay. So Moose has recognized, recorded on its books, all the assets and all the liabilities of Beaver at fair values. Right? So this basically is what has been received by Moose. Now, what has Moose given up? Moose has given up cash. So Moose paid $100,000 in cash, and Moose issued its own common shares. When a company issues common shares, you got to record those common shares. Now, 140,000 common shares, the fair value of each share at that date was $5. Moose is the one issuing shares, right? Moose's common shares on that date were trading at $5 a pop. So 40,000 shares times $5. These shares are worth $700,000. Okay. Now, if you take a look at the total of the debits, it's 1,310,000. Total of the credits is 1,910,000. Am I missing something? Did I make a mistake or something? 28,000, sorry, not 140,000, but rather it was 28,000. Oh, that would have been something. So the 28,000 shares are worth 140,000. I somehow remembered 140,000 and that stuck in my head. So Mandy, no, that was my bad. It was actually 28,000 shares, not 28,000 shares. They were worth $140,000. Okay. All right. Now add up the debits, 1,310,000. Add up the credits, it's 1,350,000. Now, certainly my debits are not equaling my credits. I have a difference. My credits are greater than the total of the debits by 40,000. Now, this in here, $40,000 difference is the outcome of the difference between consideration given up. So these guys were consideration given up. Let's splash some color here. So this is consideration given up. And these were the consideration received and this is a business combination because Moose has basically taken over all of the operating assets of Beaver, right? All of the operating assets and liabilities of Beaver. So when in a business combination, the consideration given up is more than the consideration received, that difference goes by the name of goodwill. Okay, so goodwill is recorded on the books only in the case of a business combination, all right? Goodwill is recorded on the books only in the case of a business combination and is the result where the consideration given up exceeds consideration received. What we gave up was more than what we got in return. Had it been the other way around, we will have recorded a gain on acquisition. If the total of the debits had been more than the total of the credits, the difference will have been recorded as a gain on acquisition. So goodwill cannot be negative, okay? There can be no negative goodwill. If you ever encounter a situation where the difference, the goodwill number is coming out to be a negative, it basically is recorded immediately as gain on acquisition. So Arsh, yes, that is what Moose will do. They are debiting goodwill $40,000. Moose has debited cash, debited accounts receivable, debited inventory, debited land, debited property, plant, and equipment, credited the liabilities and the litigation liability taken over, credited cash that they paid, credited common shares at fair value issued. Now, the difference between the credits and the debits, this $40,000, is the goodwill. And yes, you debit it. Now, of course, if you want to make it look pretty, you can include a line, you can insert a line here and debit goodwill there, right? If it were a negative result, Hugo, then it would be a gain on acquisition. Yes, you will credit the gain on acquisition. Yeah. All right. So if we can, so this was before the acquisition, right? So before the acquisition, this was the balance sheet information for Moose and Beaver. So after the acquisition, what will the balance sheet look like? All right. So Moose had $40,000 of cash, right? So Moose is not changing its own book values, right? So Moose is not changing its own book values of assets and liabilities. They'll remain as they are. So Moose had $400,000 of cash. To that, Moose is going to add 325,000, the cash that they got from Beaver, and subtract $100,000 cash paid to Beaver. So 400,000 was the cash that they had. You're just posting, okay? So 400,000 plus 325,000 cash taken over from Moose's bank accounts, less $100,000 cash paid to acquire Beaver's net assets. We'll be left with cash balance of maybe it'd be better if I move this. Okay, so Moose will have cash 625,000. Is that okay? 400,000 plus 325 minus the 100,000. Yes, Yifi, I'm coming to that. Wait for that. Now, what about accounts receivable? Moose had $150,000 of accounts receivable of its own. Add $180,000 of accounts receivable recognized from Beaver. So that'll work out to $330,000 total. Inventory, Moose had $240,000 of inventory of its own. Add $160,000 inventory taken over from Beaver. So that's 400,000. Land, Moose had $150,000 of its own land. Add $260,000 taken over from Beaver. That'll be 410,000. Property, plant, and equipment, Moose had 740,000 of its own, plus 385,000 taken over from Beaver. So that gives us, and Moose had $120,000 of goodwill already on its books. Add $40,000 goodwill recognized on the acquisition of Beaver's net assets, Moose's total goodwill now goes up to 160,000. What about liabilities? Moose had liabilities of 780,000 of its own. Add the $810,000 of liabilities taken over from Beaver and the $300,000 for the litigation liability that is now recognized on the acquisition of Beaver's net assets. The total liabilities works out to $1,890,000. Common shares, Moose had $400,000 book value of common shares at the beginning or before the acquisition. As part of the acquisition, Moose issued $140,000 worth of new common shares. So total value of common shares becomes $540,000. Retained earnings of Moose were $620,000. Okay. Now, if you were to add up the assets for Moose, you'll get $3,050,000. And if you add up the liabilities and equity, you get $3,050,000. And that may give us the sense, oh, yeah, done, but not quite. Because what we have not yet figured into this equation is the fact that along with all of this, the $100,000 cash paid and 28,000 common shares issued, Moose also incurred $20,000 in legal fees to complete the transaction and $12,000 in stock issuance costs. These are paid in cash. We haven't recorded this part, right? So I wanted to show this. If we ignore that part, our balance sheet would balance and we might think, oh yeah, I did it right. So just the mere fact that our balance sheet balances is not indicative of us having done it right. It just indicates that arithmetically, so far, so good. But it doesn't mean that we have completely done everything that needs to be done. So yes, we have to deal with $20,000 for legal fees and $12,000 for stock issuance costs. So what happens in that case? So when you have a business combination, any transaction costs pertaining to professional fees, brokerage commissions, etc., are expensed. Okay, so you will expense transaction costs. However, any costs incurred for issuance of common shares. So if you issued common shares and you incurred some costs for the issuance of common shares, then you guys must remember from your second intermediate accounting course, they are capitalized. And what that means is they are debited to the common shares account. All right. So what you are going to do here is for the legal fees, $20,000, you're going to clearly tell me, and this is something that I want you to do for the exam. I don't want you to just say legal fees. I want you to tell me, well, what is it that you're doing with the legal fees? Is it legal fees we've earned? Because the legal fees for a law firm indicates revenue. All right. Sometimes certain legal fees are allowed to be capitalized. They can be added to an asset. Right. So legal fees incurred for the successful defense of a patent are added to the cost of the patent, right? So don't just leave me with a vague account name. Tell me very clearly that you intend to expense. So you must say legal fees expense. That's $20,000. And for the stock issuance costs, you want to debit common shares, okay? Don't record stock issuance cost because that means nothing to me. You want to debit common shares. That's what we mean by capitalizing the stock issuance cost. So when we recorded the journal entry for the actual acquisition, notice I did not subtract the $12,000 here. Here you record, you credit common shares for their fair value because the transaction cost, the transaction price includes the fair value of the common shares issued. The stock issuance costs are capitalized to common shares, but they're done separately. Okay. If I had subtracted $12,000 here from the common shares, notice what would have happened. My goodwill will have been lower by the $12,000. Okay. I don't want that. So you want to debit the common shares separately for the stock issuance costs. And you're going to credit cash for the total amount, 20 plus 12, 32,000. Okay, so legal fees are expense. Stock issuance costs, you want to debit common shares. The part about the patent was just me reminding you from a long time ago when you were taking intermediate 1. You would have learned about intangible assets there, and you will have learned legal costs incurred to successfully defend a patent or a trademark infringement or stuff like that is capitalized to the intangible asset. Oh, you mean the information. Sorry, my bad. So this piece here moves as an unrecorded patent. Oh, good. Okay. Yeah, so that is a red herring here because moves, as I said, is not going to make any changes to its own recorded assets and liabilities. Okay. Now, had it been Beaver buying moves, then Beaver will have actually recognized or recorded the patent on its books. For us here, this piece, information number 3 about the unrecorded patent is completely a red herring, right? It's information that is superfluous for our purposes. Thanks for pointing that out. Sorry. Okay, so I've got to post this as well. I can't forget about this journal entry. So what happens? My cash then for Moose's cash will be lower by another 32,000. So notice what happens. The balance sheet falls on the asset side by 32,000. Common shares, when we debit common shares go down. So debit common shares by 12,000. And for the legal fees expense, I'm ignoring the tax portion just to keep things civil here. Expenses will cause retained earnings to go down, right? So because this happened at the end of, after the end of their fiscal year, etc., I just, I'm just going to reduce it from the retained earnings. So after posting that transaction, notice here, Moose's balance sheet is just fine, yeah? $3,018,000 for the assets and $3,018,000 for the liabilities and common shares. Okay. Now, they also asked us to prepare a balance sheet for Beaver immediately after the acquisition. So for Beaver, Beaver no longer has the cash that it used to, but it has received. So probably it'll be helpful to do a journal entry for Beaver as well, because it'll make sense to follow along. So books of Beaver. So what's happening in the case of Beaver? Beaver is going to de-recognize all of its assets and liabilities. It is going to, and pardon the fact that it looks kind of wonky. So first I'm going to get rid of all the items that Beaver is going to de-recognize. So it's going to credit cash at, now when Beaver gets de-recognizes, will it be de-recognizing the book value or will it be de-recognizing fair values? The word de-recognize means remove from the books. So Feroz says book. What do the others think? Book value says Paige. Book value says Brittany. Absolutely. So you de-recognize the book value. So Beaver's going to credit its cash, 325,000. It's also going to credit the accounts receivable, 170,000, inventory, land, PP&E. Right? It's going to credit all of those. It will also de-recognize its liabilities, which when you de-recognize a liability, you will debit the liability. I know my journal entry is not looking pretty. I'm just kind of, going through the process here. You can always make things look pretty later on your own. Okay, so Beaver is going to get rid of the liabilities at book value, 840,000. Beaver did not have the litigation liability sitting on its books, so it's not concerned with that. Okay, so this is basically Beaver de-recognizing all of its assets and liabilities, because these assets and liabilities have now been transferred over to Moose. Moose has taken over them. Now, what is Beaver getting in return? Getting cash, right? So Beaver's getting cash of $100,000. And Beaver is getting common shares issued by Moose, which are worth 140,000. So what should Beaver debit here? Beaver Company is getting common shares issued by Moose. So what will Beaver debit? Investment. Good, good, good. Thank you. So they're going to debit investment in Moose, $140,000. Right? So from Beaver's point of view, the shares that it received from Moose represent an investment in Moose. Yeah. So that's 140,000. Now, to complete this journal entry, you add up the credits, I get 1,135,000. Add up the debits, I got 1,080,000. So once again, the credits are bigger. So sum of the credits minus the sum of the debits, I'm looking at a $55,000 difference. Now this $55,000 debit on the books of Beaver, what do I debit? So you want to remember, Hugo, that gains are credits. right? You would have recorded a gain if the difference was a credit. Okay. So Preet and Arsh are suggesting goodwill. Okay, so what's goodwill? Goodwill arises as a result of a business combination where the acquirer pays more consideration than the fair value of the assets and liabilities received. So you guys have caught on to this. Pardeep actually has the correct account. So this is basically a loss on sale. Beaver has sold all of its assets and liabilities. Okay. Beaver has sold. This is what's happening, right? Beaver, if Moose has purchased all of the assets and liabilities of Beaver, Beaver has sold all of its assets and liabilities. Right? So upon derecognition, if it is ending up with a debit balance, it's the loss on sale of net assets. Okay, it's not a loss on the investment just yet. The investment has just been recognized, and we have recorded the investment at its fair value as of that date. Okay. So if we were to prepare a balance sheet for Beaver right after the acquisition is completed, what's going to happen? Beaver had $325,000 worth of cash. It derecognized that cash, but also received $100,000 in cash from Moose. Net amount of cash on the books of Beaver is $100,000. Beaver had $170,000 worth of accounts receivable, which it derecognized upon sale to Moose. So no accounts receivable. Same thing for the inventory. No more inventory. No more land or property, plant, and equipment. As far as the investment in Moose is concerned, Beaver is going to record investment in Moose 140,000. And Beaver is going to continue to have goodwill of $65,000 sitting in its books. So Arsh, the 325,000 cash that Beaver had is gone, derecognized. They received $100,000 in cash as part of the purchase, the consideration from Moose. So that's the 100,000 that is debited here. Also, if you want to check at your end, if you click on the cell, and you should be able to view what cells I'm referencing. You should be able to see where I got the numbers from. So I got this B30, D34 minus the D66 plus the C72. Can you guys give it a try? At your end, are you able to see the contents of the cells? Okay. Are you good with that, Arsh? Yeah, okay, thanks. Now the liabilities, Beaver had $840,000 of liabilities. those liabilities have been derecognized. No more liabilities. Common shares, Beaver still has $600,000 worth of common shares on its books. Now, Beaver had retained earnings negative 240,000. They had a deficit of 240,000. Now, what happens to that deficit? As a result of the loss on sale of assets, what will the loss do to the deficit? Should the deficit increase? Should it decrease? What should happen? So when you have a loss, losses will reduce retained earnings. Okay. So when your retained earnings number is already a negative, a further reduction actually means an increase of the negative, right? So that's basically arithmetic here, okay? Retained earnings goes down with a loss. If your retained earnings balance is already a negative number, then that negative amount is actually going to go up as a result. So Beaver's retained earnings is actually going to end up being a deficit of 295,000. Okay, so again, these sorts of things can sometimes play tricks on our mind. So just take a deep breath and make sure you do not flounder there. Because like it or not, as far as the balance sheet goes, Beaver's balance sheet also needs to balance, right? So after this deal is done, Beaver's going to have a balance sheet totaling 305,000. Okay, and that was that for example 6.1. Did you guys have any questions so far? Nope. Okay. All right. So what was the result of this little exercise? Our friend Beaver Moose basically took over, basically gutted Beaver Inc. Beaver Inc., after this transaction is completed, Beaver Inc. really doesn't have any operating assets left. It's got some cash. It's got this investment account, has got some goodwill, which is defunct, which will probably need to write off anyways, right? Because what will this goodwill be good for? Nothing, right? So this is probably going to be impaired away, increasing the deficit. It's got no operating assets, it's got no liabilities. So it's basically left a hollow shell of its former self. Moose has taken over all of the operating assets and the liabilities belonging to Beaver. So Moose has basically taken over physical control of all the assets and liabilities. Physical control. Okay. So this happens only when the purchase of net assets is done. However, a business combination does not always need to occur in this manner. The second way a business combination can occur is through the purchase of common shares. And this basically happens when the acquirer, the parent company, purchases, or I should use the word acquirer for now, the acquirer, whom we will call the parent, purchases greater than 50% of voting shares of the acquiree, which then is called the subsidiary. Okay, so if that happens, there's a purchase of shares, then that becomes that's a totally different scenario. So over here, when you have a purchase of net assets, is consolidation needed? The answer in the first instance is no, because Moose has taken over all of the assets and all of the liabilities. If those assets and liabilities are already recorded by Moose on its own books, there's no point, there's no reason for any consolidation to take place. Consolidation is needed when the two companies operate separately, but they're part of a single combined reporting entity, where the reporting entity is the parent company. So consolidation is not needed when we have a business combination that's done by the purchase of shares, of net assets. However, if the business combination is done through the acquisition of shares, then consolidation is needed. Okay,